if you want the slide decks, please email customerservice@nadex.com and we will send them to you. It might take a day or so. All right, I am now going to flip over to the last presentation, the basics of Nadex short-term trading products. So let's get into it. Once again, this disclaimer, as you've seen at every one of our sessions, trading involves risk and may not be appropriate for everyone. Any trading decisions you make are solely your responsibility and at your own risk. And this is an educational session. Please do not construe anything I say or anything that anyone said today as a buy or sell recommendation. We're doing this for your education purposes. I'm only leaving this up here for folks who weren't here earlier or who are watching the recordings. It's just a little bit about me. I'm presenting the session. I come off the trading floors. I've been in the industry for a little bit longer than I would want to admit. But I have had senior executive roles at Eurex, which is a large futures exchange out of Europe, Boston Options Exchange, the New York Stock Exchange, and E-Trade before I joined Nadex. Now, in this session, I am also going to leave up the slide Who is Nadex, although I am not going to go through it again. But I like to leave it up there for people who are catching the recording of this and might only watch this particular session. I am then going to talk about binary options, knockouts, and call spreads, and how retail traders can use those products to access short-term price action in the markets. And each of the products has its differences, and people find which product works best for them and in what circumstances they might want to choose one versus the other. I will do a little bit more on the platform. Hopefully I'll have some additional time, a little bit more than I had when I did the basics of technical analysis earlier. Again, I am not going to go through this slide. Just know that Nadex is a regulated exchange in the United States, and we have contracts for short-term price action for retail traders, meaning very low cost to entry. And we're going to talk about the dollar value of trades at Nadex and opportunities at Nadex. And everything at Nadex has clearly defined risk. So you cannot lose more than what you initially put into a trade. And that is important because it forces you to be a little bit more disciplined in your trading, particularly if you're a new trader. All right, let's talk about first, I'm going to call them binary options, but they're also event contracts and prediction markets. So event contracts, prediction markets, binary options. Let's talk about what these things are. And they are all short-term defined risk-reward contracts. And they are based on something. They're based on an event or a statement or a prediction. I like to really think of them all as prediction markets. And each one of these contracts, only one of two outcomes can occur. Doesn't matter what, if it's an event contract, a prediction market, a binary option. In the end, and I emphasize in the end, there are only one of two outcomes. Either the event occurs or it doesn't, or the prediction is true or it's not. That is why they're called binary options. They're binary options because in the end, it is either true or it is false. And it doesn't matter whether you're buying or whether you're selling. And interestingly enough, Nadex is a place where you can sell binary options or these types of contracts as well as buy. That's something that differentiates us from some of the other providers out there. But it doesn't matter whether you're buying or selling, your risk and reward are both known up front. So there are no surprises. You're not going to come in trading binary options and go, oh my God, what happened? I lost everything. You know what you could potentially lose before you get in, and it is quantifiable. Now, I like to call them event contracts, prediction markets, and binary options because people use those different vernaculars. They'll often use event contracts because it's around an economic report, a very specific event, like non-farm payroll. What's the non-farm payroll? Is it going to be greater than X? It's around an event. A prediction market will often revolve around more mainstream. Will a particular movie have X amount of dollars box office revenue on a given weekend? I mean, it can be anything. Binary options, it often refers to products that are tied to the financial marketplace, the S&P 500 or oil or gold or foreign exchange. We're going to talk about all of that. But the interesting thing is, when people talk about event contracts or prediction markets and go, ooh, I love these prediction markets, or these event contracts are really cool, but I don't like binary options, it doesn't make a lot of sense, because they're all exactly the same. They are all exactly the same. It is simply vernacular. It's what do you want to call them, but they're the same thing. Is it red? Is it dark red? Is it, it's like there's different shades of colors, gray, charcoal gray. It's your personal preference. So let's talk about what each of these contracts are. And to understand the binary options or event contracts or prediction markets, you'll have to understand that it's essentially a statement or a prediction, and it is made up of three components. The three components are an underlying market, a condition, and an expiration time. So when I say an underlying market, it could be the S&P 500, it could be gold, it could be oil, it could be the euro US dollar, whatever the market is. It could be the non-farm payroll number. It could be, if we wanted to say, a cryptocurrency, which we're testing in demo right now, the level of a cryptocurrency. Or it could be how many people will be immunized. It's a market. Then there's a condition, right? And that condition is often called the strike price or the level, and it's going to be defined in the contract. And then there's an expiration time. At Nadex, we've got a variety of different expirations. We've got 5-minute binary options in foreign exchange. So you get, will the euro US dollar be above 1.14 in the next 5 minutes? Will the S&P 500 be greater than 46.70 in the next 20 minutes? Will gold be above $1,800 an ounce at the end of the week? So hopefully you're understanding that these are all the same. They've got three components: a market, a condition, and an expiration time. And binary options or event contracts or prediction markets, whatever you want to call them, they will trade between 0 and 100. The price that you actually see that you're trading is a number between 0 and 100. So let's talk about what that number, the price, represents. Now, as I mentioned, these are all essentially a prediction. Either the event happens or it doesn't. It's a true or false prediction. And in the end, if the condition is true, the option will go to 100. And if it's false, it will go to 0. So let's think about what that number actually represents. And what you're trading, what's going to change in the marketplace, is you can think of that price as roughly reflecting, that's a lot of alliteration there, roughly reflecting the probability that the event will be true at determined by the marketplace at that time. So let's think about that. So you're trading a probability. You're trading a probability, and that probability is going to fluctuate over time as time changes and as the price of the underlying changes. So for instance, if you looked at a binary option and you saw the bid-ask spread, the market was 46.25 bid at 49.25. And if you look at the midpoint, the actual midpoint is 47.75%. So what the market is predicting, and anyone can buy, anyone can sell, anyone can put a bid or offer in the marketplace. It's an open marketplace. And what the market does is it creates a prediction. It's telling us that at this moment in time, right now, based upon what's happening in the market, there is a 47.75% chance that in the end, it will be true and it will go to 100. All right. Now, conversely, it's telling you there's a 52.25% chance that it's going to go to 0. Notice that if I add the 47.75 and the 52.25, it's 100%. So, I mean, that's how it has to work, because in the end, it either goes to 0 if it's false, or it goes to 100 if it's true. So if you see that market and you're trying to buy in that market, there's a 47.75% chance that as determined by the marketplace, that in the end, it will go to 100. Now, at Nadex, you can also sell these. Here's another example, all right, a totally separate example, as it just turns out the numbers are the same. But here's a market where it's 50.5, 50.50 bid, and there's a 54 offer. Now, right in the middle is 52.25. So the market is actually telling you, when you see this situation, there's a 52.25% chance that it's going to go to 100. There's a higher than 50% chance it's going to go to 100. Now, if you were selling this, it's 100 minus that, which tells you that there's a 47.75% chance if you sold it that it will go to 0. All right, so you can buy it or you can sell it. All right? And if you think it's going to go to 100, you think it's going to be true, you buy. And if you think in the end it's going to be false and it's going to go to 0, you sell. All right? Hopefully, I think that's pretty clear. But it's really important to understand that the price you're looking at, people go, well, what is the price of this? It's because it's a binary contract, because it can only go to 100 if it's true or 0 if it's false. It becomes the probability that the marketplace is giving, based upon buyers and sellers, that the event will be true. Now, interestingly enough, because Nadex binary options always have a $100 notional value, in the end, it's $100 per contract, that number also represents the dollars at risk. Now, we calculate all that for you on the order ticket, but if you bought a binary option for 25, just for example, you're paying $25. And at that moment in time, the marketplace is saying there's a 25% chance, or a 1 in 4, that it will go to 100 and you would make $75. Now, that also means there's a 75% chance you're wrong and you risk 25 and it goes to 0. All right, so, and those probabilities will adjust throughout the day. Now, your collateral, what does it cost? Because I mentioned that Nadex contracts are low notional value. Your collateral is the most that you can lose on a trade. So if you buy, when you buy, that's the most you can lose. If I pay 25 for a contract, right, I can't lose any more than $25. If I buy 2 of them, I can't lose any more than $50. Now, if I sold one at 75, it could go to 100, so I could only lose 25. I sold it at 75, I can only lose 25. So if I sell one at 75, I would only have to put up $25, and I'm risking 25 because I sold it at 75. I'm risking 25, looking for it to go to 0, in which case I would make 75. I sold it at 75 and it went down to 0. So in the end, it's either 0 or 100, and we calculate these probabilities for you, as well as the dollar amount on an order ticket. So if you look at a Nadex order ticket, and here's an order ticket for a binary option, you can see that we give you, now this is for the S&P 500. All right, and at the time, the S&P 500 was trading at 46.59 0.33. We could see that this had 22 hours and 7 minutes to go, so we give you that expiration, and we give you the condition right up top. Will the US 500, will the S&P 500 finish higher than 4659.6? Notice that the price is really close. We're 30 cents, we're 27 cents away. Now, because at this moment in time there was an upward bias, the market for this was 50 bid at 53 and a quarter. So 52 and 5/8, 52.625, that's the middle. That's the middle. And if you look at the bottom, if you were buying this, it gives me, and I'm actually going to go down here, it gives me the probability. With this market, if you're buying, there's a 51.63% chance that it's going to go to 100. All right, that's what the marketplace is telling you. All right, now, do I have to buy at 53 and a quarter? No, I could put a bid in between if I wanted. Does that mean I'm going to buy it at 52.75? No, but I can certainly put my bid out there, and if somebody wants to trade with me, they can sell it to me. We do calculate your potential maximum profit or maximum loss on the order ticket. If I were to buy one for $52.75, I know that I couldn't lose any more than $52.75, all right, because that's what I paid for it. And what could I make? Well, it could go to 100 and I'd make 47.25. I could make $47.25. Now, that would be a return. Now, our ROI money, the return on investment, does take into consideration exchange fees. It does. There is a cost to do each trade, is $1 per contract. But it does. If I were to buy one at $52.75 and I made the whole profit, and I did this in 22 hours, I can have an 84% return on my money if I were right. And they're telling me there's a 51.63% chance at this moment in time that that would happen. Okay, now remember, it's just a probability, because the flip side is there's a 48 and 3/8% chance that it's going to go to 0. Okay, so you have to remember there's always a flip side to probabilities. Now, if I were looking at the sell side, okay, just to show you how it will work on a sell side, here the market was 56.75 at 59 and a quarter. If I were to sell this, all right, notice that my probability, because I'm selling, now if I were buying this, the probability of success would be 58%. If I were buying this one on the right, there's a 58% chance it would go to 100, but I'm selling it, so my probability of being in the money is only 42%. It is already higher than the strike price, right? And so notice that it will calculate my ROI and my probability of in the money, whether I'm buying or whether I'm selling. And if I were to sell one, and here I'm trying to sell one at 59, if I sold it at 59, the most I could lose would be 41, right? Because it can only go to 100, and the most I can make would be 59 because I sold it at 59 and I'm looking for it to go to 0. So you're really trading a probability when you trade a binary option. Now, an important rule when trading binary options, I have said this several times, is it's the probability that it will finish either at 0 or 100 in the end. But that probability will fluctuate as the price of the underlying changes and as time to expiration moves forward. So this is critical when you're trading binary options. Just because there's an expiration associated with the contract does not mean you need to wait until expiration to see what happens. You can choose to exit the position early. So why would you want to exit a position early? Well, you would do that for one of two reasons. You would exit it to either lock in a profit or to minimize losses. So let's go back to my example where you buy one for 25. I buy one for 25. I know I'm risking $25. I could potentially make $75 if it's true, and it just has to finish anywhere above the strike. It does, you know, my profits are capped if it goes up. It can go to infinity. I can still only make $75. If it drops and the bottom falls out, I can't lose any more than $25. So I've risked 25. Now, it goes up, and now it goes right to the condition. It goes right to the strike price. If it's right at the strike price, there's an equal probability that it would either finish at 100 and finish above, or finish below and go to 0. There's a 50-50 chance of what's going to happen, which means the binary option is going to be trading right around 50. Now, I bought it at 25, it goes up, and now it's an equal probability. It's now trading 50. Do I have to wait and see what happens? And that would be up to you to decide. Some people like to risk 25. They're looking for a short-term pop. It goes to at the money, and they're willing to sell it right back at 50. Now, why would you do that? Well, you risked 25. It went to 50. You sold it at 50. You just made 100% return on your money. You bought it at 25. You sold it at 50. Thank you very much. You move on to the next trade. And you're not risking whether it's going to go to 100 or go to 0. You're okay not getting the extra $50 because you just took a profit off the table and you moved on. Now, that works the other way too. Let's say I buy one at 50. There's an equal chance it goes to 100 to 0. I'm risking 50 to maybe make 50, but it goes down. I was wrong. I read the chart. I thought it was going higher. I thought this was a good place to get in. I bought it at 50. It's now trading 25. Do I have to lose all 50? And the answer is no. If I bought it at 50 and it goes down to 25 and I want to get out, I can try to sell it at 25. If I sell it at 25, I just cut my losses. Instead of losing all 50, I only lost 25, and I can reassess and say, oops, I made a mistake, and reassess. So it's important to understand that when you're trading binary options or prediction markets or event contracts, you can choose to get out early if you want to lock in profits or to limit losses. All right, and that's one way to play this. And when I get into the Nadex platform, you'll see this in action when I'm doing a practical demonstration. By the way, closing a position early, we do offer some simple functionality on the platform where if I bought one, and you can see in this example, I bought one and I paid 53 1/4. I could just offer to sell one up at 82 1/4. And I'll show you this on the platform. And it's telling me, hey, I would take a $29 profit and I could place a limit order. And if I walk away from my computer and it punches higher and I'm not paying attention and I sell it at 82.25, I'd be, hey, great. I come back and find out, ooh, I'm out of my position. I locked in my $20. Thank you very much. We also have a simple close the position, and I'll show you both of these, where you're just going to send a market order. All right, I bought one at 53 1/4, and I made a mistake. I didn't mean to do that. And I know right now that there's a bid at 50 1/4. I could just send a market order right now and sell it and just take a $3 loss. Say, oops, I didn't mean to buy that. Get me out. I want to get out of this. So we do offer some different functionality on the platform, which I will demonstrate. Let's move on to knockouts. All right, now I personally think knockouts are our most intuitive product. I think they are the easiest ones to understand. Once you understand knockouts, you will also very easily understand call spreads. But binary options are the most popular. People really understand binary options. It's 0 or 100. You're trading a probability. People like that, and it's fun and it's exciting. And we have these 5-minute binaries or 20-minute binaries, and you get some great price action. Now, knockouts, on the other hand, it is a contract that has a predetermined range. We will give you a predetermined range, and that range has 2 price levels. It has a lower price level, which we'll call the floor, and it has a higher price level called the ceiling. Now, the contract itself is going to trade between the floor and the ceiling, and it will move directly in line with the underlying market. So, which is what we call a Delta 1 product. It is super intuitive because it's probably what you're used to in other markets. So let's say I were trading oil, for example, and I'm trading an oil knockout, if oil were trading $84 a barrel, the price of the knockout is 84. You're going to see the price of knockouts move directly in line with the underlying market. You're simply trading the price of the underlying market. So if I'm trading the S&P 500, because we're talking about stock market trading, and I think the S&P 500 is right around 4,600. I think I'd have to take a look. But if it's trading around 4,600, that's the price I'm trading. And if I think, just like with other markets, if I think the S&P 500 were going up, I would buy it. It's trading at 4,600. I think it's going up. I buy it. If I think it's going down, I can sell it. I can take a short position and sell a knockout, looking to profit if it were to go lower. All right, so now let's talk about how knockouts actually work. It is a Delta One product. We are trading the price of the underlying. A knockout will expire or settle in one of two ways. The first is called price triggered settlement, and that's what the floor and the ceiling create for you. If the underlying market touches the floor or the ceiling, you will be knocked out of the trade. That is why they're called knockouts. If you buy a knockout and it goes down to the floor and touches the floor, you are knocked out of the trade and you experience maximum potential loss. It's calculatable, it's definable, you know what it is going into the trade. If I buy a knockout and I think it, because I think it's going up and it goes down, and it touches the floor, I'm knocked out. Now, if I buy a knockout and it goes all the way up to the ceiling, I will get knocked out of the trade for maximum potential profit. I bought it, it went up to the ceiling, it touched the ceiling, and I got knocked out of the trade. Thank you very much, maximum profit. Now, it's the exact opposite if I'm selling. If I'm selling or going short or taking a short position, so people, I'm getting a question right now, does short mean sell and long mean buy? And generally speaking, yes. A short position is a bearish position. You're going short, you're taking a bearish position, you are selling and looking for something to go lower. If you're bullish and you think it's going up, you tend to take a long position and you buy. So again, all of these little vernacular things that we throw around and people go, So I can buy or sell a knockout, and I buy it if I think it's going up. I sell it if I think it's going down, and I've got that floor and the ceiling where I would get knocked out of the trade either for a profit or a loss if it touches either the floor or the ceiling. Now you're going to ask, what happens if it doesn't touch the floor or the ceiling? And there is an expiration associated with knockouts. They are usually set up, they are set up at the beginning of the week as weekly contracts. At the end of the week, if a knockout, if it didn't touch the floor or the ceiling, the knockout will settle at expiration, and it'll settle at a price between the floor and the ceiling, and your profit or loss will be the difference between where you bought or sold it and the price that it settled at. You simply have these other prices, a floor and a ceiling, as guardrails around your trade. So let's talk about the risk and reward of a knockout. You know what your maximum risk is, whether you're buying or whether you're selling, right? You know what your maximum risk is. If you're buying, it's down to the floor. If you're selling, it's up to the ceiling. And essentially what we're doing is we're providing in a contract natural targets, either a profit target to lock in profits. If you buy it and it hits the ceiling, we put it in. Hold on one second. Okay, we've got these profit targets. If you buy it, your profit target's the ceiling, and it's going to force you to take profits if it touches the ceiling. Your profit target, if you sell, is the floor, and it's going to force you to take your profits. And it also forces you to have defined risk. It forces you to have defined risk because if you buy it and it touches the floor, it's going to force you to liquidate because you're out. You're knocked out. If you sell it and it goes up to the ceiling, you are knocked out. So what we've done is we've forced you to have a profit target and a stop loss baked into one trade. And a trade where you're simply trading the price of the underlying. You buy it if you think it's going up, you sell it if you think it's going down, and you are forced to have both a potential profit target, as well as a stop loss baked into your trade. And it forces you to be a disciplined trader. Now, there are two reasons why we offer, because we offer 4 knockouts for every product. One is so you can choose the risk reward profile that suits you. The other is for you to maximize your capital usage. When you trade a knockout, if you buy it, you know that your maximum risk is the floor. That is what you're going to have to put up to do the trade. You have to put up the most you could potentially lose. If you sell it, it's up to the ceiling. You know what that is before you initiate a trade, which means once you do a trade, your capital requirements will never change. Unlike futures contracts where you trade on margin and you put up an initial margin and you might have to put up maintenance margin, or they might raise the margin rates because volatility goes up. With Nadex knockouts, there are no margin calls ever. You know exactly what you're getting into when you initiate a trade, and once you put that up, you cannot lose more than that. You cannot lose more than that, and your capital requirements will never change whether you're buying or whether you're selling. And we do offer 4 knockouts for every product so that you can choose, again, which risk reward profile. If you're buying, where do I want my stop level to be and how much am I looking to profit? I might be willing to take a little bit more risk for a little less reward, but I can see that when I'm doing my trade. But it also allows you to maximize capital usage or minimize your capital requirements, because you can always choose the knockout with the lowest amount of risk. And I will show you that on the platform shortly. On an order ticket, it is all, as you can see, this is a Delta One product. Here's an example of crude oil. I should have had one of an equity index, but you can see crude oil was trading at 70.62. We know that there was 3 days and 18 hours to go. Notice that I got my floor and my ceiling defined right there. The floor is 66.25, the ceiling is 71.25, and the knockout is trading in between that range. All right, because if it touches the floor, I'm knocked out. If it touches the ceiling, I'm knocked out. Now, if I were selling this, all right, I think oil, here's an example of me thinking it's going lower. Notice that the market, 70.59, 70.66, is right exactly around the current indicative price. It's 3 cents up and 3 cents down, roughly. So it is a Delta One product. And if I were to sell one, and here's me trying to sell one right between the bid-ask spread, I know that if I sold it at 70.61, if it touched the ceiling, 71.25, I would lose $64. I cannot lose any more than $64. But if it went all the way down to the floor, 66.25, I could potentially make $436. We've got different ranges for different products. We calculate all of this on the order ticket for you. So you don't have to do all this math. It is very easy to see, but I want you to understand the concepts. Now, if you understand knockouts, you will understand call spreads. All right. Now, a call spread is also a contract that has a predetermined range, and it also has a floor and a ceiling. And the price of a call spread will move in line with the underlying, very similar to a knockout. However, call spreads differ from knockouts in 2 very distinct ways. And this is where it's important. Way number 1, a call spread only expires at expiration. only. There is no price triggered settlement. So if you've got a call spread and you buy it and it goes through the floor, you are not knocked out of the trade. You're still in the trade. You have time for it to potentially turn around and the price to go higher, which you go, hey, that's great. That's really cool. It also means that if you buy one and it goes through the ceiling, you are not knocked out of the trade. You're still in that trade. So if it could turn around and come all the way back, and you can give back all of your profits. See, it's important to understand that a call spread only settles at expiration. Now, it comes with optionality, right? So that's cool if you're wrong, but because there is optionality in call spreads, it is not a Delta One product. It is not a Delta One. There will be a premium associated with call spreads. That is because volatility and time to expiration will impact the price of a call spread because it has that optionality. So just because you touch a floor or a ceiling, you're still in that trade. There will be a premium associated with call spreads. And I'm going to show you call spreads on the platform as well. Now, it's going to look very similar to a knockout. Here's an oil example, but notice here's an oil where the call spread is 65 to 70, and it's already at 70.60, so it's above the ceiling, and you could still sell it. But notice where you'd have to sell it. That's the premium that's associated with the call spread. All right, now because we know how much the call spread can be worth, there is a known, if I were to sell this right here at 69.73, I know that I couldn't lose more than $27 because it can only go up to 70. That's the ceiling. All right, and I know I could potentially make $473 if it went all the way through 65. So now you're getting a little bit of a glimpse, whether you're selling or you're buying, there's going to be some premium baked into a call spread. Now, I'm going to repeat this. I did this for binary options, and it's so important because this is when trading any place, it's good to keep this concept in mind. But when you're trading options in particular, just because there's an expiration associated with the contract does not mean you need to wait until then. You can choose to exit a position early. And I'll tell you, with call spreads, that becomes really important, particularly if you're right. If I buy a call spread and it goes up through the ceiling, there isn't going to be a whole lot more profit I can make. So in order to lock in those profits, I would need to sell it. Or I could wait till expiration, but how much more am I going to make? And it could potentially come back down and I could give back my profits. So locking in those profits by selling a call spread that you bought or buying one back that you sold. If you sold a call spread, I sell the NASDAQ 100 call spread, it goes down, it goes to near the floor, I might want to consider buying it back, taking my profits, thank you very much, move on to the next trade, instead of waiting to see what's going to happen at expiration. You can also minimize your losses by cutting your losses early and liquidating a trade early. So you would get out of a position early to either lock in profits or to limit losses. And that's true of binary options, knockouts, and call spreads. By the way, I did show you on knockouts how we had that functionality. I will show this to you, and this is the same as binary options as well as knockouts and call spreads. We do have that set profit target button on the position panel at the bottom where you can say, hey, I want to set my profit target, and it'll put a limit order to liquidate my position for a partial profit. Or I can simply click close and place a market order and just liquidate my position right there, and it will send a market order to close your position. I am going to show this to you on the platform. Again, any questions for Nadex, please email us, customerservice@nadex.com. And I'm going to now jump over to the platform because I want to walk through all of these. I'm going to spend 5 or 10 minutes on the platform, and I'm trying to incorporate I'm going to try to incorporate a little bit of the technical analysis that we discussed earlier. All right, so here we are at the platform. And let's first take a look at binary options. You can see that we've got 5-minute binary options. Those are in foreign exchange products. In fact, I'm going to come back here. We're going to watch a 5-minute binary option in action. I'd really like you to see how the volatility is. The question is, can a knockout be closed early? Yes. You can close a knockout early. You can close a call spread early. You can close a binary option early. Now, remember, a knockout will close early if it touches the floor or the ceiling. That's the only one that will close early. A call spread you would need to liquidate, and a binary option you would need to liquidate. We also have 20-minute binary options. Those are in the indices. You know what? There's 15 minutes left in these. Let's take a look at a 15-minute index. Let's take a look at the US. Let's take a look at the Nasdaq. All right. Well, maybe I want to. Let's see what else we've got here. I want to choose. They're all at the upper end of the range, aren't they? Yep. They're all at the upper end of the range. That's kind of funny. Okay, let's take a look at the NASDAQ. I'm just going to bring up, and I'm going to take away my drawings. Let's take away my channel, delete all drawings. Let's take away the Bollinger Bands I had up there earlier. Let's take a look at this is a 5-minute chart, okay? And I'm going to expand this up. And let's take a look at all of the strikes. I want to show all of our strikes. Okay. And if I really do this there, you can see all the strikes that are in there. Let's drop this down to a 1-minute chart just because it'll probably look a little bit prettier for me. Okay, there we go. Now, as you can see, the probability, now we've got 13 minutes left to go, and you can see if it's right, and now look at it, as this ticks lower, we're watching this tick lower, we're watching some of these probabilities drop. This is now going to, I mean, look at this. This dropped around 50. Now it's coming right back up, and it's starting to move above 50. You can see how quickly these probabilities can change as the price of the underlying moves around. Okay, now, if I thought this were going to continue to go lower, let me just sell one. Oh, I tried to sell one. Did I sell? I did. Okay. I sold, let's click on what I did. Okay. I sold this one at 49.25. Okay. I just wanted to get, oh, look at it. It's coming. It's going up in my face. I just wanted to, it moves so quickly. And that's because there's only 12 minutes to go. When I sold it at 49.25, I know that's the most I can make. It can go down to 0. I sold it at 49.25. It can go up to 100. I'm sorry. I sold it at 49.25. There we go. I sold it at 49.25. I know I can only make 49.25. I know I could lose 50, 75 if it goes up to 100. Because right now, you can watch the probabilities change. I sold this. As this goes higher, the probability of a short goes the other way. And as it starts coming down, the probabilities go. It's going to change my ROI and my probabilities as this moves around. Now, I sold one at 49.25. I could, look at this. I could simply say I was wrong and close it. All right, I'm just going to close it. And I just went ahead and closed it, sent a market order, and I took my lumps. Okay. And I mean, it's still going higher. It's going higher. It's going higher. I mean, it's moving around. And I just said, hey, I was wrong. Now, if I wanted to get back into a trade because I think it's going to go lower. All right. So there, I took a short again. This time I sold one at 53. Okay. I sold this at 53. And maybe I want to take a profit on this one. Maybe I take a $10 profit. So I can set this as a, oh, I'm buying it back. Hello. I want to take a $10 profit. I could place a limit order. And I've got an order down here to buy it back at 42. Okay. And I just did. Okay. It was quick. I mean, you can see how fast the price of these move, particularly as you get closer and closer to expiration. And there was an example of me both taking my lumps and eating my losses early, as well as taking a profit early. That was using binary options. Hopefully you were able to follow that. Now, that was a 20-minute binary option. Let's take a look at knockouts. Okay, I'm going to go over to knockouts, and here I'm going to take a look at the, I'll do the NASDAQ again. I'm going to click on any one of these. It doesn't matter which one I clicked on, because I told you there are 4 knockouts for each one. Now, this knockout will expire in 3 days. Notice on the left-hand side of the chart, I've got, let's move this to a 15-minute chart now. I'm going to make this a little bit easier. Okay. There, actually make it a 5-minute chart. Okay, there we go. Now, if you notice on the left-hand side, I've got 4 vertical blue lines, and when I click on any one of them, it's going to draw a floor and a ceiling. Oh, we just knocked out a 1. Isn't that funny? Now I've only got 3. One of our knockouts just got triggered because it touched the floor. So now we've only got 3. We will list a 4th one down below. We're watching this go down now. If I thought the NASDAQ were going higher, I might choose this knockout. Okay, why would I choose this knockout? I mean, here's my floor. If I were to buy one, it's got the highest floor right now. I know I could only lose 110, and if it were to bounce back up, I could potentially make 490. I'm choosing the risk reward profile. I might not choose this one, because look at the risk reward profile on this one. If I were to buy one of these, my floor is way down here. So my stop loss, yeah, I got a lot of room for a stop, but I can't make much money. You can choose the risk reward profile that suits you best, and you can clearly see where the floor and the ceiling are to suit your trade. Now, again, let's just go ahead and pick, no trade recommendations. If I were to buy one, okay, let's put a bid. Wow, I mean, this is moving so quickly. I want to put a bid between the bid-ask spread, and it's going lower. Okay, let's just place an order to buy one. I bought it, okay? I bought one for $41.69. That's actually the price that I got. I can't lose any more than $64. I could potentially make $536 if this does indeed bounce. I've got 3 days to do so. This, and now again, not a buy or sell recommendation. I bought one at $41.69. Now, could I just close my position? I could just say close, and it will just sell my position and liquidate, or I could set a profit target. Now, as it continues to tick low, I mean, this is ticking all over the place. And you can see how quickly the price of these can also move. Uh-oh, it's getting close to that floor. I'm about to get knocked out. 41.53. Look how close I am. Let's just watch. It's a 41.59. Oh, but I don't know. I'm flirting with disaster here, and I know I knew what I was getting into before I put the trade on. Are we gonna? And we're watching. It's right near. I kind of want to watch it actually knock out, and I'd be out of my trade. And I made a mistake. There, I got knocked out. All right, I lost $64. I bought one. I thought it was going to go higher, but now it forced me to be disciplined, because this could keep going lower right now. Now, again, I was just sort of picking an example out of the air, but I wanted you to see how a knockout works. And now you can see the 2 knockouts are gone. We've actually hit the floor on 2 of them. Now, call spreads, on the other hand, do not knock out. So let's take a look at a call spread, and now you're going to see where that premium level comes in. Now, these are daily contracts. There's only 51 minutes left, and look at this. These call spreads, because of how it's moved, there's no call spreads that are even in range. So we're going to have to, yeah, I don't even know if we're going to find a call spread because the market here, we got a call spread in the S&P 500. And none of these are particularly good choices either. But I could, in theory, if I thought we were going to get a rally in the last 20 minutes going into the end of the day, I could buy this call spread. Let's go ahead and buy one. All right, and I bought one. What did I pay? I paid 43.71.9. Okay, there we go. I can't lose any more than $19. I can't lose any more. Now, am I going to make $781? Well, the market would have to rally up pretty soon. And you could see the range of the call spread. A knockout had those lines drawn on the chart. A call spread's got a shaded region. And if I'm buying or if I'm selling, all right, if I'm selling, it's going to shade it red. If I'm buying, it's going to shade it blue. And I knew what I was getting into, and I'm just, again, not a trade recommendation, but why would I buy one down here at 43.71.9 and pay $19? Well, because I was thinking there might be a pop at the end of the day, and maybe we'll see a late end of the day rally, and I might be able to make a couple of dollars. But it would have to, the clock is ticking. I've only got 19 minutes to go. Now, 5-minute binary options are the shortest binary options that we have, and those happen to be in foreign exchange. All right, those are FX contracts. Here we got you want to let's actually just play around and let's watch. And you're going to see, you got to see a bit of that volatility. Let's drop this down to a 1-minute chart. You got to see a bit of the volatility of what happens in binary options when I was trading the 20-minute binary options in the indices. The probabilities of these move dramatically because there's not a lot of time for something to happen. So as it punches through, the probability will jump above 50 really quickly. If it starts dropping, I mean, you'll see these probabilities change quickly as the price of the underlying changes. Because in the end, remember, in the end, it's either 0 or 100. But that doesn't mean I need to wait until then to see what happens. I can always exit a position early. Had I bought one of these earlier in the 40-ish range when I could I liquidate it right now up at 75? Sure. I mean, I'd make a quick $35 and move on, assuming I get that if it were to do that. But this is why people do like the short-term price action in binary options. And the question was, can I do a 20-minute? I am going to go back. If you'd like to look, here's a 20-minute binary option in the S&P. So now we're going to the US 500. There are 2 minutes. Oh, look at this. There's 2.5 minutes. This is going to be like at this point, this is almost like a 5-minute binary option. There's only 2 minutes to go. We can watch. Let's get rid of this. We can watch this. Where is? Oh, look at this. It's already way below. There's only 2 minutes left. And look at this. This binary option is already, it's still giving you a chance because volatility has been so high. This is where you see volatility. I mean, this, and we're seeing this tick higher in a 1-minute chart. I mean, we're well below all of these strikes. We're well below all of these strikes. And notice how these are decaying down towards 0 pretty quickly. And even this one decaying down towards 0 pretty quickly because there's only 1 minute and 48 seconds to go. But then we'll get another 20-minute binary option. All right, that was a long day. We covered a lot. I want to thank everyone for joining us. I want to remind you, join us on the Nadex YouTube channel every morning, 7:45 a.m. Eastern, and you can get a recap, or a setup. Morning Market Movers, we live stream on YouTube. All of the recordings from today will be available on our YouTube channel. Email customerservice@nadex.com if you would like a copy of the slide decks. But you will need to email customer service at nadex.com in order to get the slide decks.